different kind of talk today. I'm going to give you a bit of a different kind of information, something I don't often do. And that's because normally when I talk about marketing or I talk about trading, well, when it comes to trading, I talk about the VEPs, right? Because that's really what matters. When it comes to marketing, I talk about other things, obviously. But today I'm going to tell you about the exact date for the end of the current Bitcoin and Ethereum and Solana and crypto bull cycle. Okay? You ready? Grab some popcorn. Have a seat, enjoy. The fact is that the exact date of the bull run will end when it does. I know, shocking, right? It will end when it tops out. And you've got all these people saying, well, it's going to be 380 days from today. It's going to be 500 days. It's going to be 650 days. It's going to be 439 days, whatever. It's going to be middle of 2024. It's going to be 2025. I mean, it's going to be the end of 2025. It might extend. It might be shorter. You know what? It doesn't matter. The date will be when the date is. If you're holding and you're not trading, that's one thing. If you're investing in it long term, you don't really care what the price is day to day. But I can tell you, if you do trade, if you look at the prices day to day, or on any given day that you actually do trade, then it doesn't matter if you're in a bull cycle or a bear cycle. And as I've said many, many times before, there's no such thing as a bull cycle or a bear cycle. But look at the charts. For this period of time, it generally went up. Yeah, you think it doesn't have pullbacks during a quote-unquote bull cycle or a bull run? No, there's definitely huge pullbacks, as we've seen time and time and time again on any asset. Bitcoin tends to pull back 80% after it reaches an all-time high. Right? Ethereum and altcoins, they can pull back 90%, even 99%. Right? Remember after the highs of 2021, where Ethereum fell to? $80. Did you get any? No? Why not? Because you were afraid it was going to go to zero. Okay. But it didn't go to zero, did it? It's now over $3,000. So for every $80 you put in, you could have basically made a few grand at today's market rate. Bitcoin fell from 69K to 15K. Did you buy any at 15K? No? Why not? Because you were afraid it was going to go to zero. Okay. Well, for every Bitcoin or part of a Bitcoin that you would have bought at the 15 grand price, it's gone up more than 4x. Not 4x, but 4x. Right, and it reached an all-time high of like 73,000 and change back in March. I'm still hovering around 68K. It's pulled back into the 50s a couple times, but it still keeps bouncing back up. Which is to say, it doesn't matter what the long view is when you're trading. Like it really, really, really doesn't matter. If you're trading intraday, what matters is the VEPs on the day. For those of you who don't know, VEPs is volatility, entropy, probabilities, and statistics. And if you don't know how to read them or use them, well, then you're missing out. Because that's actually what moves the markets. Now, I said I'd tell you something that I don't really talk about. And that's obviously the bigger picture of the supply and the demand of these limited supply crypto assets. We know there's very little Bitcoin left to mine, and there's very little Bitcoin left available to trade on exchanges. So what does that mean? That means there's basically very little Bitcoin left. If you want Bitcoin and you think the current prices are high, I can tell you, looking at it from a long-term perspective, you're probably wrong. And if you think it's going to fall to 20 or 30K again before it runs up to 100K, well, it could happen, but it probably won't. Unless it's like a snap move where somebody dumps an enormous amount all at once and then it bounces right back up. Why is that? Well, it's because of the probabilities and the statistics. Now, what does that mean? Should I get some now on 68K? I'm not telling you what to do. But do I think it would be in anybody's best interest in general to own at least a portion of a Bitcoin, which is basically proving itself every single day to be the future of money and the future of value transactions? Yeah, I think that would be a wise decision. I think it would be foolish to ignore the big train coming at you that's not stopping, and it's just making progress every single day as it moves along, and it goes up and it goes down. Why is that? Because returns distribute and returns mean revert, and price action just follows whatever the returns are doing. And 99% of the time, or some high percentage of the time, well over 90%, it's following what the returns are doing pretty much exactly. But there are times when the price action goes the other way. Even though the returns are going one way, the price action will go the other. Why is that? It's because of geometric Brownian motion, otherwise known as randomness. And that's because of what's happening on lower time frames. And the randomness there, or the random walks, or the trending moves, it's all very monitorable and tradable. And to think that just because it goes up or down, that you should deny the statistically proven information that comes from the VEPs, that is a foolish way to ignore the reality of the market. If you're unaware of market dynamics, the way actual markets are moving, and the way they move in general, you need to learn how to trade the VEPs. If you don't know how to trade the VEPs, you're missing out, and you're putting your capital at risk. You're better off investing and holding in an asset you actually believe in than trying to trade with lagging information, which is what traditional technical analysis is. So what does that mean? Well, it means that you shouldn't be wasting your time with all the gimmicks that you see and all the YouTube jimmies, as we call them at Alpha Trading, that are giving you bad signals and bad information based on lagging indicators that are built on price. What are good indicators? Well, volatility is a good indicator. Why? Because it's a leading indicator. What does that mean? That means it's telling you the probabilities of the current and future candles. If you don't understand that, well, you can learn that. And we're happy to teach you that at Alpha Trading for free. Why? Well, because we know that most traders are degenerates and they're masochists and they enjoy losing. And we also know that something like 1 in 100 people are serious about learning a better way to trade. And if you want to learn a better way to trade, what better way is there than to learn the ways that are used by the high frequency trading firms that actually control the markets? And when I say they control the markets, I mean they move the vast majority of orders and they move the assets accordingly. Right? They run something like 80% of all the trades across all assets, across all asset classes, across all markets, across any time frame. How do they do that? Well, they have position sizes that allow them to do that. So again, if you want to know that, by the way, you can get the free volatility starter pack from Alpha Trading to learn the basics of how to trade the VEPs, literally for free. Just go to our Discord and ask for it in the request support channel. Just create a ticket and request your free access to the volatility starter pack. And the Discord URL is alphatradinghq.com/discord. Once again, that's alphatradinghq.com/discord. And why should you do that? Well, like I said, if you actually want to be a trader and you want to get proper access to leading information, well, that's how you do it. That's where you learn the fundamentals. If you don't learn the fundamentals, you're more likely to get wrecked than not. If you do learn the fundamentals and you actually understand how the assets move, well, then you can actually see for yourself how the VEPS works and how you can take advantage of them, even with the free tools, to be consistently profitable. Even, like I said, even with the free chart, even with the free indicators, you can learn the basics and you can learn how to trade. And once you do that, then guess what? We have a free trial that you can use, you can sign up to, and you can get access to more than a dozen of our top indicators in our Pro Traders subscription package. We've got more than 40 indicators, but we will let you use more than a dozen of them in our free trial. Why don't we give you full access to the 40? Because it's a long and arduous process to grant you access to all 40 indicators. And frankly, 2 weeks is going to be a very short time period for you to learn those dozen or so indicators that we give you to try for free, right? But you don't just sign up for it when you come into the Discord. You have to learn the basics first with the free tools. We won't let you get the free trial for 2 weeks. We won't even let you pay for our Pro Trader package unless you actually can demonstrate that you know how to use the free tools. Right? We're not in this to sell you indicators. We built a community for serious people who want to be serious traders. If you want to be a degen and gamble your money away, knock yourself out. Enjoy it. We're not going to stop you, but you're not going to do that with our tools. At least not with our Pro Trader package. We're not going to let you pay for the privilege of losing your money. You're already doing that with your garbage indicators from all the silly YouTubers you're following. Right? They're probably selling you courses and crappy indicators that aren't worth the money that you're spending on them. They teach you psychology courses and all this garbage. They're not even psychologists. They just make up courses and call them psychology courses. They read a book. We all know the book. They read one book. They synthesize it into a so-called psychology course, and then they sell it to you for 100 times the price of the book. You could just read that book and be like, oh, this is ridiculous. There's buy pressure and there's sell pressure. That's what moves markets up and down. There's returns. There's standard deviations of returns. There's Laplace distributions, right? There's normal distributions. There's entropy, which tells you whether or not the asset is on a random walk or a trending move. You want a psychology course? Here's your psychology course, okay? Step 1, take profits early and often. Step 2, limit your losses. It means if the trade goes against you, you get out of it as quickly as possible. You don't stick around and wait for it to maybe turn around and go your way. If you're wrong, accept that you're wrong, get out of the trade. Limit your losses. And step 3, do not be emotionally attached to your trades. I'll say it again. Step 3 is do not be emotionally attached to your trades. That's it. That's all you got to know as a trader, right? If you do those things, those 3 simple things consistently, you have a higher probability of being consistently profitable than people who are selling you lagging indicators and psychology courses and garbage information and signals. We don't give you signals in alpha trading. Now, if you watch our live streams and you look at our analysis, you'll see we're pretty much spot on every day in terms of our probabilities, where the price action is likely to go. Why is that? Well, it's because we know how to read our tools. We know how to read the information and take the appropriate action. If you don't know how to do that, guess what? You can learn how to do that. Like I said, it's free. Okay, so enough about that. And let me return to the big picture here. We know that the amount of capital available in the market is many times, in fact, infinitely more than the amount of Bitcoin available. And we know that increasingly, people with capital are buying up Bitcoin. And there's very little left. Like I said, there's maybe like 4%. Call it 10 if you want, but there's maybe like 4% of all Bitcoin really available on markets, right? Say there's a million Bitcoin, even though we know there's less. A million Bitcoin currently available on exchanges actually for trading, right? Because if you remove all the amount of Bitcoin that's already mined and held in offline wallets or in wallets that are not connected to exchanges, and if you remove all the amount of Bitcoin that's just being held on exchanges but not actively traded, the amount of Bitcoin actually available in trading is less than a million Bitcoin. By the way, same thing with Ethereum. There's less than 10% of all Ethereum available for trading, right? And it's even less than that if you remove all the amount of Ethereum that's not being traded and is just held on exchanges. And there's plenty of that because plenty of people buy Ethereum or Bitcoin on places like Coinbase or Bybit or Kraken or Gemini or Binance or wherever, and they just hold it there because they don't want to trade it. They just want to hold it, and they figure those companies are safe to hold it on relatively. And if they get hacked, my funds are probably seifu, as CZ used to say. So there's very little crypto actually available, which means this is really a time when a lot of people are going to be buying in as much as possible. And this is not to FOMO you in at all. This is not at all. I'm just telling you what people are doing. And we can see it based on the amount of purchases. But who's actually buying? Is it retail traders? No, it's not. It's institutionals, huge banks, big companies, companies with a lot of money, central banks, Federal Reserve type organizations, right? Governments, they're buying as much as they can. They have assets they can buy. They have money. They have capital. They can buy some crypto. And they're buying enormous quantities relative to what's available. Why are they doing that? Well, they're doing that because they see and they comprehend that it is the future of financial transactions and value transactions. It's not just Bitcoin and Ethereum. It's also Solana and Binance and BNB coin, whatever, and Litecoin, and you name it, right? The top 100 coins or so, and there's millions of coins, but they're the ones with a lot of capital. They're putting their money usually in what they consider are the safest bets. Bitcoin is by far the safest bet in terms of what people consider, financial analysts consider to be a risky asset. They consider Bitcoin to be the least risky because it's proven itself. It has an ETF, et cetera, and now Ethereum does too. I would still argue that Ethereum has a massive problem for scaling, which is the gas fees, but derivatives don't have to worry about that, like Ethereum ETFs. But nevertheless, these are considered the safer assets, and those are the ones that are going to probably remain at the top of the heap, and that's why people are going to continue to buy them and hold them. So for people who want to actually trade this stuff, you need to understand that there is a very limited supply available, and it is disappearing very quickly. Right? This isn't 2015 anymore. You can't buy Bitcoin for $1,000 a pop. You can't buy Ethereum like you could in 2016, relatively cheap, or even at the high then, when it, went over $1,000. It's just not a thing that you can do anymore. When it peaked out at the beginning of 2018, whatever. It costs much more to buy these assets now. And there's a simple reason for that, right? There's more demand and there's less supply. This is basic market economics 101. If you don't understand that, you should really learn about economics. Basic law of supply and demand. So remember, the amount available is depleting much faster than the amount that's becoming available for all of these top assets. Because the people with a lot of capital, they realize that the risk is very low relatively to the reward that they might get. And they're willing to risk a certain amount of capital because they see the general direction of the returns. They see the general direction of the price action that follows. And they understand that, yes, these are volatile assets, but at the moment, there is more buy pressure than sell pressure. And as long as that remains the case, we are going to see the continuation of this so-called bull cycle, which is, again, just more buy pressure than sell pressure. We're going to see that continue until it stops. And when it stops, it's going to be a big pullback. It's going to last who knows how long. Could be 6 months, could be a year, could be 2 years, could be 3 years, could be 4 years, right? We don't know. We can't predict that 100%. But we can predict very accurately the probabilities and use those probabilities to our advantage as traders intraday. And so that's really what I wanted to tell you about. Intraday traders, the big picture does not matter. Long view holding, generally speaking, we're in a time now where there is more buy pressure than sell pressure. But that does not mean there can't be huge pullbacks, because there obviously are. Right? We went from a high of 74 or 73 and change down to like the low 50s. Is it possible that that's going to happen again before it starts running up again significantly towards 100K or whatever random round number people want to throw out there? 250,000 for Bitcoin? Yeah, it's entirely possible. There are definitely probabilities that indicate that it'll do that. But is the price action currently following the returns in general? Yes. On the higher time frames? Yes. Are we likely to see in general in the coming months a significant amount of buy pressure, more than sell pressure? Currently, the probabilities indicate that yes, we will. Does that mean that we're going to hit 100K by the end of the year? It doesn't matter. If you're a long-term holder, you really shouldn't care about that. And if you're a day trader, you definitely shouldn't care about that. You should care about taking your profits early and often, limiting your loss, and not being emotionally attached to your trades. So that's all I got to say about that. Thanks again for listening, and I'll see you in the next one. Happy trading.